We back. Bonus video for the evening. My buddy messaged me in Discord. He's messaging me right now. He inspired me in a couple things. He showed me a really nice, really cool indicator. He got me on some really good ideas with order blocks and uh, higher order pivots and that kind of stuff. So if I find anything interesting there, I'll do a video on it. But what I really wanted to talk about, he brought up how he doesn't quite understand gamma exposure. Gamma exposure charts like this basically showing you where the markets are positioned or under hedged essentially, or hedged for that matter. These charts, they don't make a lot of sense, especially when you don't use them all the time. I use them every single day. And I think the guys that do use them a lot, if you practice using them, you start to notice patterns within the gamma exposure. You start to notice things. You start to get like a crazy sixth sense about what's going on in the market. So learning how to use them extremely important. But how do you learn how to use them? What does it mean? Here's what happened on. This is SPY. All right. What happens with SPY? We've been watching SPY for all week. So go back and watch those videos. You'll see we're talking about SPY 380. SPY 380, I'll talk about that in a little bit. SPY 380 was a massive magnet. You see it just keeps trading. SPY 380, SPY 380, finally broke it, caused a little bit of volatility, got right back above it. So, what you're seeing here is the market moving towards a level where the market makers, they're essentially pushing the market so that they can get delta neutral. That's my understanding of it. That's why that 380 was such a pin, such a magnet, because there was so much of it there. Like I wish I could have kept some of those charts from before where the 380. So we're looking at this. The 380 gamma exposure was, I think it was even minus 100 million, which is pretty rare for SPY to be at minus 100 million. It's rare to be minus 50 million on a single level. It was literally the only one that had any gamma exposure for 2 days straight. So that was right into the end of the quarter. So that's another thing. Context. It was right in the end of the quarter. They got just massive gamma exposure on this 380 for 2 days. So here's day one, day two, into the end of the quarter. So you can see they traded around it all day. They still had a ton left of gamma exposure on Thursday as well. So two expiries in a row, 380, 380. So that was a massive opening up under that was huge. Okay, so that's the essentially the thinking that I had coming into Friday. So I knew that as soon as we tried to go up to 380, if we opened under it, boom, we sold off. Now, why didn't we sell off? We sold off because there was a lot of gamma exposure sitting here at 375, all through these levels here. You had lower order gamma levels, and then you had a massive 370. You had a 370 that was tagging minus 50 mil. Okay, so that was new because that wasn't there the few days before. If you watch all these charts every day, you'll see that was new. That was new gamma. So that means that this market's going to sell off. It means it's going to be a pop to 380, sell off. Why does it pop to 380? Because there was still a little bit of gamma exposure there. So they had to get rid of that, clean up an aisle 380 of GEX, and then take it right down. 375 was going to be the next one. Now the 370s was new gamma exposure. I said this in the chat that this is new GEX. This wasn't there all week, and it just showed up from the day before. So when the open interest shows, gets updated in the morning, they go ahead and calculate the new gamma exposure levels. That's what this one was showing up as new. It wasn't there on Thursday. So since it's new, that means the market is going to be attracted to it until basically this starts happening. The charm and the Vanna start working against those puts, all those puts that the dealers need to hedge against themselves. As charm, time essentially, and volatility start to work against those puts, the market maker no longer needs to get delta hedged. They no longer, the market makers, the dealers, liquidity providers, whatever you want to call them, they no longer need to go to that level anymore. So it starts to act as a repellent. It starts off like this, right? It starts off like, hey, we're trying to get down here. We're trying to get to this level because there's gamma exposure there. We need to get delta hedge, blah, blah, blah. It's really just a market function. But as time moves on, as the day weans on, as those puts start to get closer to expiry, there's an exponential headwind against them. In this case, time was the main one I was thinking of, because right here, this right here, this spot right here, I said, basically we're going to come back and retest the previous low. I said, this is probably, I literally said this in the chat, is it time to buy the 380s? Because I knew that if they can't bust this down, and it didn't really seem like the Bears had the volume, or things were still positive. You still had Apple positive. You had Tesla kept bouncing off of its the 666. You had Amazon positive pretty much the entire day. So you had a lot of really big stocks that were positive. Something would have to break in order for SPY to break this low. So 380s was probably the thing, because why? 380 was a thing all week. And so as time ran out, look, right around noon, it was like, in my mind, if I was a bear, then I'm sitting here going, dude, this thing ain't breaking unless they can break this down, which it doesn't really look like there's any momentum for that. All these puts get closed out. Okay, so they ended up getting all closed out, and I wish I could show you what the end of the day chart looked like, but that's why you got this squeeze. It was a charm and volatility squeeze, because if you come look at VIX did nothing all day. So as volatility comes down and time works against those puts, that's where you get this type of move. So if you knew, hey, if you don't need to know all of this in order to catch this move, because it was pretty simple little, hey, there was like a little bit of a triangle here. So you got a really nice 50-50 here either way, even if you didn't understand what was happening underneath the surface. And so this is, I wanted to go through this to just let people know that if you're going to use these charts, you have to understand how time and volatility are going to be working against the positions. It's going to work the same way for calls. Okay, so here's Tuesday. All right, so our big level here at 386 in their expected range here. Pretty nice wide expected range. So it can do anything. That's what I know, that it can do anything. 386 would be watching that level. Probably goes to 386. Especially if there's time on their side. If they gap this thing up, they're probably going right to 386 at the most for now. And so we'd be watching the 390s next. If they can't get it to 390, there's not a ton of gamma exposure here to really act as fuel to bring it back down. So my guess is at this point they take it right to 386, and boom, you're just going to sit there all day unless people start buying more calls before Tuesday. Or some event happens for Tuesday. So this would be my essential analysis here is, depending on where we open, we're probably going right to 386. We're probably just going to sit there all day, according to what this looks like right now. Now this picture can change. If they start adding here, then I'm going to start thinking, okay, 390 is definitely possible, if there's time left. So if we're sitting here, so say this is our next day, right? We're just going to say this is our next day. Say we open right where we're at, and we're looking at 386. Okay, so 386. If we open right here, I'm thinking, that is quite the move, especially for a continuation. Take it right to 386. If I start seeing 390s and it's early, then I'm saying 390 is definitely possible. But if we're in half of the day, it's already past noon, it's 1 o'clock, and we still haven't been able to clear that 386. There's not a lot of GEX being built up on 390. I'm just going to sit there. I'm not going to do anything. I'm not going to short it. And the reason is because even if they started building up a ton of puts here, if it's late in the day, it's likely those just end up going to zero, because the dealer has no real incentive to bring the market back down to that level, because their deltas don't need to hedge themselves as much. Their deltas they're not in danger of not being delta neutral or outside of their comfort zones of being delta neutral. There's probably some variance there, but yeah, there's not a lot of chance of reversal unless we open up Tuesday morning and the open interest gets updated. In this chart right here, they've got two levels here and even a level outside of the expected range that are built up with negative GEX. Then I'm going reversal. I'm going, okay, 386, I'm buying puts, right? Because they're going to take it right down there. That happened. If they got plenty of time and they're putting people off guard, they're putting the market maker off guard where he needs to correct everything and get delta neutral. Hopefully this makes sense. I don't know if it does. So let me know in the comments. I'm learning myself as I'm saying this stuff. So if it makes sense to you, Please let me know. If it doesn't, please let me know. Peace.